So now we're going to take a look at some ethics regarding the financial statement reporting. Ethics are the set of guidelines that define if a behavior is moral or not. An ethical dilemma can occur when a decision may positively affect a group of individuals while negatively affecting another group at that same time. In this type of situation, one should evaluate all possible consequences in order to make it before they make a decision. And they would then need to choose the course of action that result in an optimal outcome for the most amount of people involved. Accounting ethics then are going to be the standards by which an accountant judges that the financial status of the business is being accurately reported. Owners and managers of businesses have some level of control over how revenue and expenses get recorded and reported on the income statement. The owners and the managers have an ethical responsibility to record and to report revenue and expenses in a way that best represents economic reality, even if doing so means that the company reports an available result. And so notice there in bold, it says reporting what the owners and managers want it to be instead of what actually is considered accounting fraud, because fraud is the intentional act of deception that results in a financial benefit or gain. That's one thing that we cannot do. We cannot be engaged in fraud. And there obviously are major consequences to the organization if we do that. And because of some things that happened in the past, that's why ethics, particularly in accounting and particularly with how things get reported in the books, it's why it is so important. And one of the things that happened in the past, there were companies such as Enron and WorldCom, which I'll read a little bit about here in a minute. But because of things that happened there, they were basically what's called cooking the books, meaning that they were keeping two sets of books and they were making it seem like the companies were doing a lot better or had more revenue than what they actually did. And that obviously created a deception in that it made it seem like to the investors that the companies were doing real well. And unfortunately, it came out that obviously that the companies weren't doing very well. And that obviously hurt the employees of the business. It hurt investors. It hurt a lot of people because those businesses now no longer exist because of that. And the people lost their life savings because of that. And so perhaps and that's because of that specifically, what happened at Enron, what happened at WorldCom. That's why there now are so many laws and things. So one of the things that I'm sure later on we'll probably hopefully talk more about in the class is we have what's called Sarbanes-Oxley or SOX, which was a piece of legislation that was passed specifically geared towards financial reporting and why we have to, be very intentional with this and very careful to make sure everything reflects what actually happened, not what we think happened. And so let me read to you from the text. And so perhaps the most infamous example of accounting fraud that involves misrepresentation revenue comes from Enron, which was at the time, it was a large energy company in the United States. Over a period of 5 years, Enron reported an increase in revenue of more than 750%. We know that that's not possible, that would happen. This massive increase in revenue was partly due to counting the full amount of trading contracts instead of just the brokerage fees as revenue. They were an energy company. They were involved in trading energy and that. So just being aware of that and making sure that things are recorded appropriately. But they did that because they wanted to defraud investors and they were wanting to make it seem like they were doing better in order for their managers to get bonuses and other things. Another example of corporate fraud was committed by a company called WorldCom. They were a telecommunications company. In addition to misrepresenting revenue, they did do that. They did misrepresent revenue. But in addition to that, they also took certain expenses and instead of recording them as expenses, they actually recorded them as assets on the balance sheet. By increasing revenue and eliminating certain expenses, WorldCom was able to show a very large profits, much larger than what they otherwise would have been able to. In both the Enron and WorldCom cases, the executives were charged. They actually went to jail for their involvement in the fraud, and not just state prison. They actually went to the big house. They actually went to federal prison because of that. So it's important, to think about, what's happening. And you might think, well, right now it helps me or it helps the company, but what's going to be the longer term impact of that negatively that, everybody that's going to be impacted by that. So we're going to take a look at something called the fraud triangle, and you might have seen this possibly before. But the fraud triangle framework, it states that fraud may result when there are three factors that are present: pressure, rationalization, and opportunity. And we'll talk about this later on. There's a section in the text we're going to talk more about controlling cash and controlling fraud and different things that we have to do, And as an accountant, that's something that we will have to do. We have to help our company, and advise our managers and others in how to avoid fraud, avoid things to make sure things are being recorded appropriately. So, for example, the owner of a banquet hall requires additional financing from the bank in order to help to pay for an expansion of the hall building, and they feel that their income may not be enough to get the loan. And that's the pressure, right? They're thinking, man, you know what? I really want to expand my physical facility, but my revenue may not be enough to support that. And the bank may not want to give me the loan to support that. So that's the pressure, that they feel. They feel like, man, if I don't do something, then I'm not going to get the outcome that I want. So that's the pressure. Now, while the owner knows that she's not supposed to manipulate the numbers, she believes that it's going to be necessary not only to benefit herself, but she thinks it also would benefit her employees who need their jobs at the banquet hall in order to continue to make their living. And that's the rationalization. She gets to thinking, okay, well, I feel this pressure now. And I think, well, man, you know what? If I do this, it's going to help me, and it's going to help me to be able to keep my workers employed. So in order to make her net income appear higher, the owner starts to record customers' deposits as revenue instead of as a liability. Remember, they're not revenue until the event has taken place. Because the owner also acts as the company's accountant and there's no one else that double checks the accuracy of the financial statements, that provides the opportunity. And so that allows her then to inflate her revenue and her profits, hoping that the bank would then be able to grant her the loan that she needs. And this action, it would be unethical. And one of the things we'll talk about later, and I think in when we get to that section, there'll be a discussion question about it, and there'll be a video, again, kind of speaking more about the fraud triangle and how it works. I believe that's in chapter 10, is thinking about, how, just being aware of that. And so then as an accountant and as a business owner, you have to set things in place. And one of the things that you have to do is what's called segregation of duties. So you have multiple people involved. You don't have just one person involved. And in this case, there was only one person involved. Very common for a small business to be set up that way. But because of that, it makes it then that we could have a fraudulent situation. So we have to be just more aware of the situation. So which of the following would be unethical? Borrowing money from a bank that charges a high interest rate, recording customer deposits as revenue before the services are performed in order that we would be able to inflate our net income, recording expenses when they are incurred to minimize taxes, or the owner to withdraw cash for personal use and to record it in the owner's withholding withdrawals account. And it would be all of those except for B are correct. You really wouldn't want to do A, but there's nothing really unethical about it. But the other ones, that's how C and D, that's how those things are done. But B, recording customer deposits as revenue before the services are performed in order to inflate our net income, that would be, we don't do that. That's improper.